What if I told you there are ETFs, paying a staggering 15 to 33% yield that don't secretly destroy your portfolio? The brutal truth is that most high-yield funds are financial quicksand, promising you income while your initial investment slowly bleeds out. But the 5 ETFs I'm revealing today completely break this rule, delivering both massive monthly paychecks and real capital growth. This isn't just research. I personally own 4 of these 5 ETFs, and I'm going to show you my exact positions and why I'm betting my own money on these game-changing strategies. Last year, I watched a friend get lured into this exact trap, seeing his $15,000 investment get cut in half in just 9 months while he was busy collecting those generous dividends. That disaster sent me on a mission to find the biggest secret of investing: high yield without decay. After digging through hundreds of funds, I found them. By the end of this video, you will know exactly which 5 ETFs to buy, why they work, and how they can transform your portfolio into a true income-generating machine that actually grows. Part 1. The core income and growth engines. First up is an ETF that has become my secret weapon for generating steady, high-yield monthly income. The ticker is QQQI, the NEOS Nasdaq 100 High Income ETF. This fund completely shatters the myth that you have to sacrifice growth for income. Right now, it's boasting a 15.35% distribution rate, which translates to a consistent 60 cents per share hitting your account every single month. But here is the critical part that separates it from the yield traps. Since its inception, it has delivered a 27% total return. Your principal is actually growing. My personal goal is to hit 2,000 shares of QQQI. The fund holds the top 100 non-financial companies in the Nasdaq and then runs a systematic covered call strategy over the index. This isn't a risky gamble. It's a data-driven approach to harvesting the market's natural volatility and turning it into cash. For every $10,000 you invest in QQQI, you are looking at $1,535 in annual income, paid out in reliable monthly chunks. Part 2. The Weekly Paycheck Solution, MAGI. Now, if you thought monthly income was good, the second ETF takes it to a whole new level. The ticker is MAGI, the Roundhill Magnificent 7 Covered Call ETF. This fund does something truly unique. It pays you every single Friday. It literally turns your investment into a weekly paycheck system. MAGI focuses exclusively on the 7 companies driving the entire stock market: Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia. It then leverages their massive volatility to generate a mind-blowing 34% annual yield. And just like QQQI, it has proven it can grow, delivering a 13% total return since its inception. The weekly distributions are remarkably consistent, typically paying out between 27 and 47 cents per share each week. It averages out to over $1.15 per share per month. The strategy is straightforward. MAGI holds these 7 tech giants and writes covered calls against them. Because these specific stocks have such high volatility, especially around earnings reports, the premiums collected from selling those options are substantial. This is how it fuels that incredible 34% yield, while still giving you exposure to the upside of the most dominant companies on the planet. Part 3. The High-Octane Bitcoin Income Plays. All right, the next ETF might surprise you, especially if you're not a crypto bull. The ticker is BTCI, the NEOS Bitcoin High Income ETF. And before you roll your eyes and say you don't do crypto, just look at the numbers. We are talking about a yield hovering over 30%, combined with a nearly 60% total return since its inception. I was skeptical about generating income from Bitcoin at first, but when I saw BTCI consistently paying out around $1.40 per share every single month, I had to pay attention. The strategy is pure genius. It generates that massive income by writing call options on Bitcoin futures. And here is the key takeaway. The extreme volatility that scares most investors away from Bitcoin is the exact feature that fuels these massive monthly paychecks. Because Bitcoin's price moves so dramatically, the premiums collected from selling those call options are enormous. The fund captures that volatility and turns it directly into a high-yield income stream for you. But there's a flip side. If Bitcoin falls sharply, BTCI will experience losses, even with the options strategy providing some buffer. In a sudden crash, BTCI's synthetic futures positions could amplify losses. Part 4. Aggressive Weekly Bitcoin Income. Now, if BTCI is the high-octane monthly play, our final ETF is the max income version that pays weekly. The ticker is BAGI, the Amplify Bitcoin Max Income ETF. This fund is for the most aggressive income seekers, paying a staggering 32% annual yield. It writes weekly call options instead of monthly ones. This allows the fund to collect those juicy premiums 4 times more frequently, which translates directly into a higher yield for investors. BAGI has delivered a solid 15% total return since its inception, all while maintaining that incredible 32% distribution rate. The innovation is all about frequency. By harvesting premiums every single week, the fund can adapt more quickly to market conditions and capitalize on Bitcoin's constant price movements. But let's be very clear about this one. This is not a core holding for most portfolios. It is a satellite position, a smaller allocation for investors who want to maximize their income generation and are comfortable with the higher volatility that comes with a weekly options strategy. The results are impressive, but it's a tool that requires you to understand and accept the associated risks. Part 5. The Balanced Bitcoin Approach. Now, if the high-octane strategies of BTCI and BAGI feel too aggressive for your risk tolerance, let me introduce you to the perfect middle ground. The ticker is BITY, the Amplify Bitcoin Strategy Plus Income ETF. This fund was created to solve a huge problem for income investors. How do you get exposure to the explosive potential of Bitcoin without the insane volatility and lack of income? Think about the dilemma. Pure Bitcoin investments can be incredibly volatile, and while they offer massive growth potential, they generate zero income. On the other hand, traditional income investments are stable, but often lack any meaningful growth, giving you no exposure to the digital asset revolution. BITY was built with a dual mandate to solve this exact problem. It's not just about collecting options premiums. It is specifically designed to capture Bitcoin's price appreciation while simultaneously generating a substantial income stream. The numbers prove that this balanced strategy works. BITY targets a powerful 24% annual yield, paid out quarterly, and has generated a solid 15% total return since its inception. So who is this ETF for? It is the perfect crypto allocation for income-focused investors who want to participate in this new asset class without taking on excessive risk. If you are crypto curious but the thought of buying Bitcoin directly makes you lose sleep, BITY offers a much more measured approach. You get meaningful exposure to Bitcoin's potential upside while collecting a significant quarterly distribution. Part 6. The Implementation Strategy and Risks. These ETFs are powerful, but they are not magic money machines. They come with a very specific and critical trade-off that you must understand before you invest a single dollar. The high income they generate comes from selling call options against their holdings. This strategy generates cash today by selling away some of the potential for explosive growth tomorrow. If the Nasdaq or Bitcoin goes on an absolute parabolic tear, these funds will underperform a direct investment because their upside is capped. So, here is my recommended execution plan. First, you start small and you diversify. Do not go all in on just one of these funds. A much smarter approach is to spread your capital across all 5, creating a blend of the different strategies. This gives you exposure to the Nasdaq, the Magnificent 7, and both the monthly and weekly Bitcoin income plays, which smooths out your risk. Second, I personally reinvest most of my distributions. When you are compounding a 15, 20, or even 30% yield, the growth can be absolutely explosive over time. Of course, you can also use the cash flow as income if that's your primary goal. Part 7. Crucial caveats, taxes, and risks. These massive distributions are almost always taxed as ordinary income, not as qualified dividends. This means they are taxed at your highest marginal rate, which can be a huge drag on your returns if you are in a high tax bracket. This is a critical factor you must plan for with your tax strategy. These funds are often much more efficient inside a tax-advantaged account, like a Roth IRA. Finally, from a portfolio allocation perspective, these high-yield ETFs should be a satellite position, not your entire portfolio. I would recommend a maximum allocation of 10 to 20% of your total portfolio. Use these powerful tools to boost your income and total return, but make sure you maintain a core of traditional, low-cost growth investments. If you've made it this far, I have a powerful ETF guide designed just for you, and it's completely free. This guide includes a checklist of the 5 most important things to look for in a high-yield ETF, monthly monitoring tips, and even a printable tracker to keep your income growing without the risk of decay. All you need to do is comment ETF on this video. Once we reach 50 comments, I'll share the link for everyone to download. So now you know which high-yield ETFs can actually hold their ground. But what if I told you there's a way to collect dividends almost every single day? In the next video, I'll show you the ultimate guide to stacking payouts so often it feels like your portfolio has turned into a cash machine. Don't miss it.